right, good morning, everybody. It's a pretty light Friday when we think about what's on the docket today. One Fed speaker, a little bit of news coming out of Europe. Um, the 10-year kind of went a little crazy yesterday. So that's going to be something you really want to continue to listen for when you're reading articles or just kind of flipping around out there. Anything that's discussing the 10-year. It was odd too because yesterday we were watching the dollar and watching the 10-year, and the expectation is that if either one of those go up, that it's kind of a negative weight against the marketplace. And the dollar really wasn't moving around all that much at the time, and yet the 10-year was really making strides. And it was like, well, we would have thought those two were going to be working together, and it's not what we got. There is a rig count today, but after working on those rigs for 20 years, normally they don't change. The number doesn't change very much. There have been times where it's radically changed, but most of the time it's going to be 3 to 5 rigs. Not a really big deal. We were almost 100% priced in for a 75 basis point rate hike, and yesterday they started actually pricing in a 50 basis point rate hike. So they're unwinding 25 points here. Now it's only just started to do that. But if that picks up steam, we're very likely going to see that upside move that I've been talking about all week. I've been stating that we have a new bottom, and it's not the bottom, right? I'm not making that statement. But we have a bottom, and we're very likely going to get a new bear market rally, something like we had through the late part of June into July, and then everything changed in the breath, and we rallied into August and hit our head on that 200 period moving average. I contend that this is a new base before we make another move like we did then. And if they begin to unwind 25 points out of this, that will definitely fuel the fire for that bear market rally. All right. I had someone ask the question yesterday, how accurate is this? And I think they must have assumed that this is some sort of guesstimate, right? Like a guess. I don't know any other way to imagine what they were thinking. This is not some hypothetical. It's not a guess. We're not assuming. This is math. Right? They're looking at the contracts being traded, and they're running the numbers to give you the probabilities of a rate hike between 50 basis points and 75 basis points. So the question just kind of highlighted the fact that the person really didn't know what the heck we were looking at here. When you look at volume, for an example, and you say that the volume is up because you can see what it is today and you can see what it was yesterday, you're not making some hypothetical assumption. You can see that today's volume is greater than yesterday's, or less than yesterday's if that's the case. So when you're looking at this, you're looking at volume, contracts traded. This isn't some guess or assumption. Not much changed yet in the December series. I would really continue to watch those Novembers today. See if this 50 basis points starts to increase significantly, which will cause the 75 basis points bar to go down. All right, now in the last week, we've seen a change from a Fed pause and or maybe a 25 basis point rate hike to a potential 50 basis point rate hike. We've been seeing that increase for the February series. So they're pricing in 25 basis points there, kind of moving the curve or kicking the can down the road. Not a whole lot of changes here on the December. In 1 week, they unwound a 50 basis point rate hike, and they've been pricing in 75 basis points instead. So we'll see how it plays out, all right? All right, so we got retail sales at 8:30, and really, I mean, that's about it. That consumer confidence flash, I just don't, I don't see how Europe is really going to give us anything more to worry about at this point beyond the whole FX contagion crisis, right? I mean, that's this. I really don't see how it's going to provide much of an impact today. But when it comes to the econ, you never want to turn your back on it, right? So just at 10 o'clock, watch the clock and make sure you don't get ran over, right? Volume's a little light this morning. Nothing too extreme, just sitting in the lower end of the 100,000. It's fine. It's not a real big deal. What we're concerned with is if we were to come in and see that it was below, say, 90,000. Or if we came in and found it sitting closer to 300,000. Either one of those, right? The extremes. Otherwise, if it's not in the extremes, we just turn that off. We don't need it. Right? So now you can see that we've got this consistent, persistent move to the downside this morning, running these waves. Lower highs and lower lows. Nice little uptick there that kind of broke the system. And speaking of higher highs and higher lows, yesterday we had a really nice 1, 2, 3 fail pattern set up. I think it might be better to look at it in the SPX. This is the 1, 2, 3 fail. And if you notice, we had it 2 days in a row. So the market sets a high. That becomes the benchmark. And it pulls back like a market does because it doesn't move in a straight line. And it makes a new run. And it fails to even get back to the previous high. That is a warning right there. Pulls back again, setting yet a lower low. And makes another run towards the top. And it fails to even achieve the previous pivot, let alone the first pivot. This is a 1, 2, 3 fail pattern. The market finally says, screw it, and just sells into that sucker hard and fast. You notice it did the same thing the day before. It's a little tricky to play, but when it starts to set up, the very first hint that you might have a 1, 2, 3 pattern unfolding is that you set a high and you pull back from it and you fail to achieve an equal high. That's your first warning or heads up. We are underneath the daily pivot. We have not touched it yet. That makes it an MDP, missed daily pivot. You can Google that if you want to find a strategy on how to approach it, how to trade it, what it even means. There's some really good videos out there on it. It's not my strategy. I didn't make it. I didn't invent it. So for any kind of move to the upside, we would first need to get back inside the box. The box would be yesterday's price action. The easiest way to mark yesterday's price action would be to just come out to the daily chart. So we need back in the box. And as you can see, we're getting a little bit of a Busby here. We broke out of the box. We're making a run at it. Should we reject off of yesterday's low, the RTH low, then we're very likely going to come down and retest our own Globex and then start working through the ADR and that weekly pivot point. So we've been IX10 for 2 days, and we're getting an IX10 completion here unfolding. It's another trade set up off of the daily time frame. An inside day, just one, is an inside day. You start getting multiple inside days, and you start to develop an IX10. We've been building up a lot of contracts here. We could be talking about the SPX, Apple, right? Anything that has a similar beta and movement as the S&P. The longer we've stayed in this sideways range, building up more and more and more contracts and open interest, the greater the move is likely to be when we finally do break out of it. Now we're still in the Globex, obviously. So as we come into the open, the cash session, that's when things are very likely to begin to get more interesting. With no real econ on deck, this is going to be a market looking for a catalyst. So what that means is it doesn't really have to be anything really big. Any kind of news could spark a riot, so to speak, in trading, and they could just dump it. The thing about trading is when it comes to the buy side, there's always somebody willing to offer you whatever it is that you want to buy, right? Buying is not the problem. If you're a buyer, you'll always find sellers. The problem is when it's sell side. This is why the markets go down so fast when the markets do go down. When you're buying, there's always sellers. But when you're selling and everybody else is selling, trying to find a buyer can get a little tricky, right? And so then people jump in front of the line, they jump the queue, they hit BB below the bid just to make sure they get filled. And of course, you're not the only one hitting below the bid. Everybody's hitting below the bid, and the market falls like a brick in water. So when it comes to a market waiting on a catalyst and a spark that could send this market going in either direction, the downside flash crash is most definitely in effect today. I mentioned Tier 1 Alpha the other day. They have GEX levels, they have gamma flip levels, gamma bands that look very much like Bollinger Bands, and they have free material. So if you were to go over there and sign up for it, they'll literally send you an email every day giving you Apple and SPY and the Qs with these levels that you can add to your chart, to your trading platform, right? And you just go in and draw the lines where those flip levels are. We do have OPEX today. I continue to hear more and more about the level of zero-day trading and short duration trading that's going on. Even the institutions are doing it. That's how heavy and how extensive the short duration options trading is. Just keep in mind it's still really new. And the more that it's around, the more people are going to know about it and learn about it and use it. We have not had 5 expirations throughout the life of trading options, right? We used to only have monthlies, and then we had weeklies, and then about a decade ago, they gave the S&P the ability to have 3 expirations in a week. Within the last year, they converted that in the SPX to 5 expirations a week. Obviously, we're trading it more because we have more opportunity to trade it. Yes, it's the market environment, and even the institutions are trading really short. No argument from me there. But don't forget that the quant numbers are different now because we have more days to trade it. It has to be taken into consideration. The short duration options volume, where these institutions and retail traders are trading 0 days and 2-day expiration trades, it does not calm the market. It creates more volatility in the market. It's more violence. It's more drastic sweeping action. It is just violent. So, we want to see that kind of back off as we begin this rally up, right? Volatility is the nerd word for movement. So when you're looking at candles, what you would notice in a good market when we're going up is that the size of the candles decrease and their movement becomes a more uniformed pattern, cleaner, clearer, more simplistic. They actually have a trend or a pattern to them. And when we're going down and the volatility is high, the candles are very big. It's jumping from up and down, and they're drastic swings and gaps. That may be like a Captain Obvious moment, right? Like, thanks, man. I think I figured that out long ago. But you'd be surprised how often this escapes people's attention. When we're in a good, clean, bullish market, even if it's a bear market rally, low volatility equals very beautiful, very uniform price action, like that right there. And you can see where things were violent. We had these big, massive sweeping candles. And then when we turned bullish, the candles got small and uniform and clean, and we traded. Well, the same thing goes with options. These short duration options are just a part of the volatility. They are a part of the violence. So we want to see that short duration violence start to fade out as we begin this rally up, which we haven't got yet. Right? My argument has been that this is a new base. Well, as long as we're holding above 3,500, then that argument is true. And I would say I really don't want to see it get below 36, but 35 is the line in the sand. We want to see a base built, and then we need a higher high, which at the moment we do not have. I didn't like this lower high. Certainly didn't like the idea that it was a tweezer top either. But until proven otherwise, I'm still going to contend that this is a base. So let's talk turkey. To the downside, if things were to get violent today, which is really what we want to focus on, not the wishy-washy, sideways, kind of, sort of, maybe it could stuff. We want to focus on what if things really light up, right? So an ADR to the downside would be 36.24, and the full ADR would be 35.76. And that measurement is not me assuming or guessing. all we're doing here is using math, and we're asking over the last market month, which is 20 days, what has been the average movement on a day-to-day basis from its highest point to its lowest point. The average movement in the S&P has been around $100 a day, or 101 points. It's 2.7%. Today, right now, we have an additional 75%, 0.75%, 0.75%, and it's a market maker move. That market maker move is based on the fact that our front volatility is greater than our back volatility. And we look at the first two series. All right, and of course, I'm on the universal contract, the continuous contract. But if I was to put in, a specific contract, you'd be able to see it better. There's our 0 day right there, and we are at 24. And then here is Mondays, and it is at 20. And it is this differential between the 24.7 and the 20.15. It's because of that we have a market maker move at all. I've seen some really smart people sound like freaking idiots trying to explain that simple little thing right there. And it's not because I'm some genius, it's because I read an article that told me what the hell it is. You can go to the Ticker Tape, which is a publication of TD Ameritrade, and they will explain it in excruciating detail and tell you exactly what it is. So you don't have to try to figure it out on your own. So we have a market maker move of 0.75. I'm going to round up, a little creative license. That would give us a 3% ADR today, or a 3% expected move on the day. We could move that much, and it wouldn't even be considered extreme. We're not reaching. So 3.5 gets us, 35.5. 35.5 is a level that sounds familiar. I believe we have, I need my continuous contract back. Yeah, we have some levels back here. This is 35.08. It was the first pivot after we recovered from the COVID lows. So we'll do both. We'll do the 35.5. And then we'll do the 3,500. The 35.5 is the ADR added to the market maker move. We could go that far, and it would not be considered extreme. But what if things do get extreme? If things do get extreme, then we will go beyond 3.5%. But here's the thing. Statistically and historically speaking, the S&P doesn't make 4+% moves frequently. Now this year we've made a lot of 2% moves. We've even made a handful of 3% moves and 3.5% moves. So while we can move 4 and 5 and 6 and 7%, we never want to say that price can't do that. We most definitely want to have a little bit of perspective here and say that it's really unlikely to make that kind of move, especially since half of the day is done already. If we had been drilling to the downside and we were already down 2.5%, then I could say it'd be much more likely that we could move 5% today. But we're negligibly down 0.5%. So I'll stick with the base case argument of 35.5, and if things really get out of control today, 3,500. And that would put us down to the first recovery pivot outside of the COVID, right? It would also put us below the weekly pivot point, which at the moment we're still holding above that. So we've talked about the sad side. Let's look at the happy side, right? The side where we go up and everybody's cheering and secretly grateful and buying a bunch of junk. We would first need to get through that pivot point, 3,700. We got a cog line at 37.11, which is also one of my fib retrace levels. Then we got the ADR half, 37.25, 28 creative license. The previous week's high, which we've tried to get out of a few times and it just can't seem to stick. And then the high of yesterday, 37.50. The ADR full is at 37.80. And what we want to do is price in a 3.5% move. So we're going to take one of those lines from down here. Just set it there for a moment. So from the close or from the Globex open, it really doesn't matter which one you use. We want a 3.5% move from that, and that gets us really close to the 38.11 cog line. It's actually a little less than the cog line, but if we get that close, we're going to hit the cog line. So that would be our upside and our downside extremes. And it really would be extreme. It won't be sneaky. It won't be subtle. If we start going like that, oh boy, you're going to know it, right? It'll be very violent, very fast, very extreme. So you won't have to worry about like not noticing that it's happening. $10-day, 30-minute volume profile. We are underneath the point of control. The TPO point of control is nowhere near the volume profile point of control, showing that we obviously spent a whole lot of time in the lower portion here around 35.90, and yet we have a whole lot more volume at our 3700 area. We're coming into a little bit of volume support. It's not something we want to trust like a handrail. Don't lean on it. Don't assume that it's going to support you or help you. We use that term loosely, right? Support. First touch, say we come down and bounce. Yeah, we'd very likely bounce on that first touch. But that's the play, right? It's bounce and then drop. Or trounce or whatever word you want to use there, right? Bounce and break. First touch play. The way I like to phrase it is, if we were going to reverse and begin going the other direction, this level of support is one place where that's likely to happen. And then if it doesn't happen there, we focus on the next one and we say, okay, well, we made it through that level. If we're going to reverse now, it would be at that next level. That worked perfectly yesterday, by the way, when we're looking at the SPX and was looking for the reversal. Right? Everybody play that reversal good. It worked perfectly, just the way it's supposed to. So the line in the sand as we made that move to the upside yesterday was, okay, there's the high of the previous day. And when we get there, that's very likely a place where we could pivot and fall. And if we don't pivot and fall there and we actually make it through there, then we would have the next pivot point. And when we get there, if we're going to reverse and turn, that's a likely place for it to happen. And sure enough, We made it through the first one. We didn't make it through the other one. Not with a closing candle anyways. So it wasn't the idea that we knew it was going to turn there. It was just the idea that if we were going to turn around, that is a likely place to do it. The way linear regression works with this line is what you get on one side, you very often reciprocate on the other side. So right now, when we've got this move right here of that distance, we want to plot the same distance on the other side, because that is very likely what we're going to get when we do reciprocate. So we're looking here at the day-by-day volume profile. And the reason we come out to this chart every day is we're looking to see if we can carry forward points of control that have not yet been hit. When you run day after day after day sideways, you don't get any untouched points of control. We had one back here for a few days, and then it was hit. Right, we hit it on Wednesday. Now that we've hit it, we wouldn't carry it forward anymore, but that's the idea behind it, right? We come out, we plot these forward, and then if they remain unhit, then they stay on your chart days, weeks, months, years, until we revisit a level and finally take them out. But we don't have any to mark out. You could carry forward the value area high and low. If it's what I was taught to do, if you learn to use the volume profile, it's what will be suggested to you. I never really found any value to that though, because I'm already carrying forward the highest point of the day and the lowest point of the day, which is usually really close to those anyways. But hey, to each their own, right? So we have a real wishy-washy, kind of, sort of, maybe morning. It's a little odd. We want to see the fireworks come in. Bonds are still a really big deal. And oh boy, there she goes again. This is not good. It's not right. This is really, really dangerous, and it's one of our biggest risks at the moment. Since the dot-com bubble of 2000, for 22 years, we've stayed above that line. Sure, we wicked down below it in the 07-08 crisis. You know, we got near it during the Christmas craze in 2018. But we've been above this line for over 2 decades. And little wicks below it has no comparison to what we've got going on right now. So I can't stress it enough. This is crazy dangerous. And it is one of the most important things going on right now. If you remember how bad things were in 07 and 08, look at what this was doing in 07 and 08. Not much. So it's bad, right? It's really, really bad. And it won't take much to really spark things. This is why we keep saying that there is a risk of an upside crash. I know people don't think markets can crash up, but a flash crash, imagine if the Fed has to come out and play the hero, and they suddenly have to quit raising rates, and they make some statement or announcement that they're not only going to stop raising rates, but they're actually going to do a rate cut. Just imagine the move that would come to the upside of this market, right? We would take off like a SpaceX rocket ship. Now, they've made every promise that they're not going to do that, but if the entire global monetary system was starting to unravel, Do you think they're actually going to let it unravel? So that's the risk, right? We still have the play here in US dollar Japan. The target was 151 with a possible overshoot to 152. Got it. But it's not done yet. Still going, right? They were supposed to defend the other day. They must have been using a paper sword because their defense sucks, right? This like the most horrible defense ever. Maybe it was the Kansas City Chiefs. Oh, possible. If you don't want to play the pair per se, you can use an ETF, right? So it's the FXY. You can short the ETF, right? Like buy puts, or you can trade the pair. Go back to the US dollar Japan and trade the FX. But you're likely going to need a different account to do that, right? Or, get permissions on Thinkorswim to do it. So there is a volatility index for bonds, kind of. It's called the MOVE Index. It's Bank of America's MOVE Index. And as you can see, the volatility within the bond market is extreme, right? It makes perfect sense. Things are, beginning to unravel. And we're getting near this breakout on the month, right? It's a monthly candle breakout. So instead of an inside day or an inside week, we've got an inside month breakout. Now, this contract or this particular product by Bank of America, it's a really, really young product. It's only been around like 2.5 years, so I can't chart back farther than this. But we are at the highest levels that the chart offers, right? Now, if I remember correctly, this is not something that is charted intraday. So, if you was to go in and try to, if you try to see it on the intraday, it's just one solid candle, right? Because once a day they come in and they put the numbers into it. Very much like, it's not a Renko, like a range chart. So you need to at least be on a daily, and you're only going to get that update every day in the afternoon. Friday afternoon, take a look at the MOVE index after the close tonight and see if we are sitting at a new level to the upside. The benchmarks that we've been using and talking about is still in place for the VIX. As long as we are maintaining inside of this channel, we don't really expect much out of the market. Should we break and close below $30 or $30.25 on a daily time frame, we're going to expect the S&P and the Nasdaq to begin that new leg up. If we break above 35 on a daily and close above 35, we're going to be looking for the S&P and the Nasdaq to break to the downside and set a new leg low. It really is that simple, right? Now, those are end of day discussions. It's end of day if we close above these levels. So on the intraday, that doesn't really help out a whole lot unless you're swing trading, because at least you could begin the start of a trade. It's the same kind of thing when it comes to the dollar. 115 has been the level that we've been using, but it is a long ways off, right? And so I've added kind of like what IBD does, and IBD will offer like an early entry with a little asterisk and a warning, and they'll say this is an early entry, but it's not the appropriate entry. Well, we'll do the same thing with the dollar here in this discussion. If we break above 115, we would expect the S&P and the Nasdaq to begin a new leg lower, right? Breaking 3,500 and kind of getting down to like 34, 33, that kind of thing. But that's a long ways off. We want to tighten it up a little bit. So we'll use an earlier level, but it's not as good. So 13.5. If we get above 113.5, you could expect the S&P to at least be knocking on the door to the lower end of this base that we're in. So this is the base. This is our area of discussion. If we break and close above 13.5 on the day in the dollar, you could have every expectation that we're going to likely close in the lower portion of this range or this zone, and that we will not be able to rally out and make new legs to the upside. Makes perfect sense. But we wouldn't really expect the S&P to break down below 36, definitely not 35, until we get above that 115. Now, it's not a must-have. Right, we're talking about what would happen if the dollar got above 115. The S&P could fall below 3,500 without the dollar's help. Right, it can get down there on its own. It doesn't need the dollar to do it. So we're talking about watching the dollar, seeing where it's going, and if we notice that it's above 13.5, we're going to expect weakness on the day, maybe a continuation move to the downside, not a drop in, right? Not like a brick in the water kind of drop, but a consistent, persistent sell side pressure, just keeping us lower. But should we get above 115, we're very likely going to break below 3,500 and set a new leg lower. If the dollar gets below 112, it's an early drop. We'll continue to move off of the lows of this box, but still maintain the box. Probably press against the highs of the box and be positive on the day. If we break below 110, we're very likely going to break out of the 3,800 box, start testing 39, maybe 39.5. So simple benchmarks between the VIX and the S&P, the dollar and the S&P, and right now that 10-year is really something to add to the list because of what's going on with the bonds. Look at that parabolic rise. That is freaky scary. The levels in play, 47 is the next level if we can get past my warning center of 42.6. So we're very likely going to get there and consolidate a little bit, press it and chop it, maybe pull back a little. If we get through 42.6, the next target that I have is 47.06. Yeah. Well, we don't have anything to the upside really of note. Yes, the DXY is absolutely breaking out. It heard me talking about it, obviously. You gotta love it when the dollar says, "Oh yeah, hold my beer and watch this." No, man, it's freaking 7 o'clock in the morning. No beer for you. So as you can see with all the XLs lined up just beautifully in order, the negativity is expanding up the chain as we go from healthcare through consumer staples and then consumer discretionary and industrials, materials, and energy, all the way through to communications, which is down the most this morning at nearly 2%. We do have some that are kind of flat. Well, I wouldn't focus on, right? My benchmark is 0.5%. XLF is nearing that 0.75%. Emerging markets. So, yeah, I mean, it's pretty negative out there, which is what we would expect with that move in the dollar. Stocks declined as Treasury yields increased. Traders waging that the Federal Reserve would keep raising interest rates until inflation was overcome, and investors analyzed how well prepared corporations were for a variety of challenges in the earnings reports that we've recently seen, which is a really big deal, right? That's been kind of this was supposed to be the start of a new, not a new, but of a weak earnings cycle, right? We need this earnings valuation bubble to pop, and it's not so far popping. And now they've got to kick the pivot can down the road, and they have to argue about what is the new normal or neutral rate. It's certainly not 2%, and looking at the current valuations, it's not 3% either. So if they can't decide what normal or neutral is, how do they know when we are in some slightly restrictive territory, quote, quote, because that's what we're aiming for? I like that old phrase that was used in Congress years ago in the discussion of porn. I guess you'll know it when you see it, right? You'll know when we are in restrictive territory when you see it. Until then, I guess we won't know. So what this is shaping up to show this morning is that unless something comes in and drastically changes or alters the conversation, we're very likely going to have a another sideways to down day. And we want to focus on those levels that we talked about. Just remember that at the moment, nothing has changed in connection with, say, some bit of economic news. Sentiment, behavior, attitude, what the market is feeling, that's what's moving things this morning. The VIX is not responding to this. Right? I mean, yeah, we're up slightly, don't get me wrong. There is a little bit of movement here. But the VIX is not freaking out. The dollar is freaking out. Whoa, Bitcoin is giving a lot of it away. Remember, we're looking for a 50% cut. And I'm saying that with the percentages in the right spot. If you say Bitcoin at 20, I say cut that in half, Bitcoin at 10. Right? So we're on the way there, obviously not in a straight line. That's a significant drop in Bitcoin. Gold's right behind it, but still above the pivot. The bonds. We had this beautiful draw, and now we've got the raid. So one thing that I continue to circle back to is that VIX. Now, granted, I'm using the VIX futures. I'm not using the VIX, but even if we did, we're not even above the pivot point that we set earlier in the Globex session. I have crypto positions, yes. Some of them are buy and hold because of places that say, well, like when Tasty Trades added crypto. They said if you deposit 50 and buy crypto with $50, we'll give you $50 of crypto too. So I've got, obviously, free money. I'm going to do things like that, right? I've got positions there because of that. Coinbase did something like that at one point. I've got some there. So it's kind of scattered around a few different places. I've got that kind of stuff. So not necessarily things that I bought because I was happy to have it, but basically I bought it because, hey, if you're going to give me free money, then give me free money. On the other side of that, I trade crypto on the Smalls exchange using the Smalls futures. And I like to do it that way because you can actually trade it. You can go long and you can go short. If you're just like trading Bitcoin, you can only buy. I don't want to only be a buyer. I want to be a trader, which means I want both sides of the fence. For anybody who wants to trade Bitcoin without actually trading Bitcoin, there are ETFs now. Yay! Every time I say that, I like hear the cheering in the background of yay. BITO is an ETF that you could use to trade Bitcoin. It's going to be just like any other ETF, right? Like XLI and XLY and XLF, those are ETFs. This is an ETF. So you can trade Bitcoin this way, and that way you can trade options on it and go long and go short, and you don't have to get, um, you know, cryptocurrency accounts or anything like that. The Smalls exchange was actually bought out by a crypto firm. They own it now. Tom Sosnoff sold that to them. This here is now owned by a crypto company. And it has a crypto futures product. And speaking of crypto futures, there's actually, you know how we have a mini and a micro? Well, there's a nano crypto futures product out there as well. And I mean, it's crazy tiny. But it still allows you to participate in the futures. And as a futures product, you can buy it and sell it, go long and short. You're not just stuck trading on the long side like all those crypto fools that I see running around out there trading on coins, and all they can do is buy a position and exit out of it later. Stuck on the buy side. That's not trading. So yeah, everybody have a good weekend. Please be careful today. Watch the clock and watch those FX markets. That move in the bonds, I can't stress how absolutely crazy it is and dangerous it is. And I will see all of you on Monday.